Welcome to the Metro Blue Capital Podcast, the real estate investing education domain. Tune in for interviews and discussions with successful real estate investors and entrepreneurs. They share their knowledge, experience, and key advice on how to build cash flow from real estate and achieve financial freedom. Let's get started.
Hi, this is Eric Lisogorski, founder of Metro Blue Capital and host of Metro Blue Capital Podcast. Today, I'd like to discuss the pros and cons of investing in multifamily real estate, along with the breakdown of the underwriting process to determine whether or not it's a good investment. So let's get started. Let's dive in. I'd like to discuss some of the things that we look for in the underwriting and due diligence process when determining whether or not a residential multifamily property is a good investment or not. One of the things I like to do when I've located an area is to speak with multiple property managers in the area that reside in the area and also manage multifamily in the area. They're an excellent source for a lot of very important information, such as the type of area, what's going on in the area, the type of renters, jobs, the crime in the area, etc. So that's just one of the things in the due diligence process that we look at. Another thing that is very important is this a landlord-friendly state or city? You would not want to invest in an area that the state law allows tenants to live there for a substantial period of time, being delinquent in rent or damaging the property, and you're not able to evict them for a very long time. The longer they're there, the more damage they can do to the property, and basically it could cause a substantial monetary loss. You don't want that to happen. So you need to do your due diligence and verify that it is a landlord-friendly state. Obtain information from sellers. We like to go as far back as possible and get as much info as we can from the sellers of the property. Their expenses, their income, the age and the condition of the actual property, along with the big ticket items such as a roof, boiler, HVAC, etc. We want to be ahead of the game and have as much information as possible. We obviously do an inspection of the property, physically go out and take a look and verify everything, but as much information as possible up front. What's market rent and how can we find ways to add value and raise the cash flow? A lot of these mom and pop owned multifamily properties, they're charging under market rent. And that's a wonderful opportunity for us to turn things around. So that's what we look forward to doing that when acquiring these properties. Proximity to major highways, just an added bonus for the renters. They may work on the other side of town, and it being convenient and quick, easy access to the highway, they get to work on time and quicker, so that's a good thing. Renters versus owners, you want to make sure that there are more renters in the area than there are property owners. You want to keep that occupancy rate up as high as possible. Average cost per door should be less than the median house value. If properties are selling for $50,000 in the area and your cost per door is $45,000 or $50,000, why would they purchase or rent a property when they could purchase a property? So you want to make sure there's a rather large gap in the home value compared to the cost per door. Income in the area should be typically three times more of the rent expenses. So if their rent is $10,000 a year, you want to make sure they're making roughly around $30,000 so they can cover their other personal expenses as well. Job growth, very important. The more jobs, the more renters you're going to have, people moving into the area, the more certainty. So job growth is a great thing. Crime rate, is it a safe neighborhood? Another thing I like to do is to speak with police departments, local police departments, and get a feel for the crime in the area, if it's a safe area or not. I personally like for my tenants to live in a very safe area. So that's very important. There are also a lot of crime maps and tools online to verify and see what type of crime there was in the area within a radius, a certain period of time. So that's very interesting. Population growth. The more people moving in the city, the better for you. Like I said, occupancy rate. You want to keep that up. You want more people living in the city. Home price growth. If the property values are going up, guess what? Your units are as well. So that's appreciation. Comparable property sale price and rent in the area. We want to make sure that we're not overpaying for a property. A lot of times we're able to get properties under market, which is an excellent thing. There are many different situations people are in. They may be in debt, divorce, bad partnership, the heirs of the deceased owner. They may want to liquidate and not deal with the property, so they let go of it at a good price. Sometimes even paying market, the numbers work amazing. You can still get those double-digit returns, even sometimes when paying market price. But you always want to get a good deal, and preferably off-market properties. So we have connections with many brokers that are connected with multifamily owners, and we get information that way. Company chain establishment shouldn't be just one industry, but a wide array of different industries. You don't want to be in an area that there's only one type of industry. For example, the whole community may be dependent on one Amazon warehouse. Well, what if they get up and move, or some type of law is passed and taxes, or for whatever reason they get up and move, and it would be devastating for the community. So it's very good that there's diversity: medical, retail, food, malls, schools, maybe colleges in the area, warehouses, etc. So that just adds extra layers of security for your tenants to be able to work and pay rent. Needless expenses that can be cut to improve net operating income and cash flow. Utility conservation techniques. There are certain cities that require, for example, you to pay water and sewer, and that can be very expensive, especially when the tenants know that they're not paying for it. They may have extra guests coming in or several children. One of the techniques that I incorporated in my properties is low flow water aerators and shower heads. That cuts the water in half, if not below that. So that will raise your net operating income up substantially. So it's very useful to employ those techniques, along with common area LED, LED light bulbs, etc. Expense ratio by class. The older the property, the more expenses you will incur due to the age of the property. So depending on when the property was built, the older it is, obviously the expenses will be higher. So we, in general, a C-class property, much older, it could be 80, 100 years old plus. The expenses we expect to be 50 to 55%. A B would be 45 to 50, and A-class, which would be 10, maybe to 20 years old, 15, 20 years old, 40 to 45% expense ratio. Business plan and exit strategies. First, we do the underwriting due diligence, determine if it's a good property or not, and will be profitable for us. We acquire the property. We do a value add, increased cash flow, appreciation, which would include any rehab, management, and rebranding. We may want to give it a whole new, fresh new look, rebranding, a new management office, maybe different backsplash in some of the units, paint, just spruce it up a little bit, make it pop, and that way we can get market rent and have it improve the cash flow. We do a cash out refi in roughly year 2 to 5, returning majority, if not all, of the investor's initial investment while they continue to receive quarterly cash flow distributions from the property. In year 5 to 10, we sell the property at a profit, and the investors still retain that ownership in the property. So if we get it for $1 million, sell it for $2 million, and they own 80% of the property, they'll get the 80% of the $1 million profit. So again, the cycle is we acquire the property, improve, reposition the property, we raise the rents, get it performing, market rent, and get the occupancy up, boost revenue through energy conservation, increase occupancy at market rate, refinance the property, and then we dispose the property between year 5 to 10, determining what type of property and how the deals works out. So I'd like to discuss the pros and cons of the multifamily residential real estate investing. I could not really think of many cons because it's really a win-win situation for anyone getting into it that has done a very accurate and stringent due diligence process to verify that everything, all the numbers add up, the property, the condition of the property, and whatnot. The pros: cash flow, 10% cash on cash returns. It's phenomenal. I have a lot of friends, individuals I know that
They're heavily invested in the stock market. It's gambling, in my opinion. Some mutual funds, and they're bragging to me about collecting 5-6% on their mutual fund. This is a very stable investment. People need a place to live, and they will continue to pay rent. 10% yearly cash on cash returns phenomenal, and the quarterly cash flow distribution. Legacy wealth. This is an asset that you're able to see with your own eyes and touch it and just go physically there and see the property. From the day the property was constructed, it's been throwing off money, and it will continue to do so for another 100 years. This is a long-term investment, so any relatives or heirs would be collecting residual income on this, as well as any of the profit at the disposal of the property. Appreciation. In general, real estate appreciates, so you have appreciation built in this multifamily. Tax benefits through depreciation and cost segregation. This real estate is without a doubt one of the most amazing investment opportunities as far as tax incentives are concerned. With cost depreciation, you're accelerating the depreciation, and there are even opportunity zones, for example, to where you acquire a property, and once you've sold the property, you have to hold it sometimes 10 years or so, and after that, whatever the capital gains are, there's no tax. So also the quarterly distributions and cash flow coming from the property, because of the depreciation, you're saving a substantial amount of money on, and may not even have to pay little tax, if any, on the cash flow from the property. So the tax benefits are unbelievable with real estate. It's much easier to manage as opposed to smaller multifamily or single family real estate. Imagine owning 100 properties around a city. It's 100 different roofs, 100 different structures, 100 different boilers, HVAC units, etc. And it's also much more difficult, time consuming, and expensive for property managers to go out to these properties and to get them rent ready, or to visit or turn on or off utilities. So it's much easier to have everything under one roof, or a few large roofs for an apartment complex, for example, and having on-site management. It's much cheaper, much more convenient. Stability, low risk investment, and a hedge against uncertain times, market crashes, rising interest rates, and inflation. Like I said, people always need a place to live. Real estate is a hedge against inflation and crazy times that we're living in right now. For example, this video is being recorded in August 2020. It's no secret what's going on now, and occupancy rate is up on my properties, and everyone's paying rent. No issues. People there are plenty of jobs, so people are able to work, and they just need a place to stay. So it is a hedge against such things. Some of the cons in multifamily real estate investing: it is a long-term investment. So your money is going to be tied up at least for 2 or 5 years until a cash out refi is done. So you get a majority, if not all, of the money back. So it is long-term, and when you're going into the investment, you have to realize that. But then again, you're getting the quarterly cash flow distributions and the appreciation of the property, and with the goal at the end of the day, once the property is sold for profit, you reap the benefits of that. So it can take a little longer to execute on the business plan to produce the double-digit cash on cash returns due to possible evictions and problematic tenants that hold us back a little longer. So we have a business plan with each property, and to get it running up to par and the market rent, we may have problematic tenants that take a little bit longer to evict. May add a few months, 6 months, possibly even a year sometimes to the plan to get it to perform the way we would like to. So those are really the only cons that I could think of when investing with multifamily. As you can see, it's a very, very safe, secure, and profitable investment. And there you have it. So we went over a few of the basic things that we look at in the underwriting and due diligence process to determine the profitability of a multifamily residential. And I hope you like the information. If you have any questions, please feel free to reach out to me at www.metrobluecapital.com. And if you like this information in this video, please subscribe below. Thank you, and happy investing.
Thank you for listening to today's Metro Blue Capital's podcast. For more information, please visit metrobluecapital.com.